This year, 2013, will likely be a more positive year for gold than 2012, if history is a reliable indicator. Over the past decade, since gold began to regain its stature as money, U.S. election years have been lackluster for gold, and the following year has shown a significant rise in price. Currently, it takes very little for short-term optimism about gold to turn bearish. This is a further indication that gold has much further to rise. Each time a hedge fund or a government intervention causes a precipitous drop, such as we saw twice in December, gold sentiment becomes weaker. Mark Holbert of Gold Newsletter Sentiment Index had this to say about negative sentiment towards gold. Of the last 3 decades has shown that at the 95% confidence level that statisticians often use to assess whether a pattern is most likely genuine, gold tends to do better in the wake of low levels of bullish sentiment, like now, than in the wake of excitement and enthusiasm. This past year showed a strong negative bias amongst most sentiment indicators, such as the Holbert survey and market vein. This is a strong contrarian signal for the coming year. Over the next decade, the golden debt chart shows the projection of U.S. debt, assuming gold will continue the same close relationship with debt as demonstrated in the historical gold and debt chart discussed earlier. Now, gold's price is directly proportional to the massive amount of debt that is being created to keep the current fiat system alive. This will likely continue until a crisis, such as a severe global recession or hyperinflation, strikes one of the major developed economies. Either event will be bullish for the gold price, but for different reasons. The price is being driven by the physical market in the developing countries such as India and China. China has to continue buying as much physical gold as possible if they expect to eventually compete for the world's reserve currency status. Some estimates state that the Chinese hope to have at least 10,000 tons to outrank their main competitor for gold, the United States. In 2012, gold mine production was approximately 2,700 tons, of which India and China bought nearly 2,000 tons between them. For the past 5 years, emerging markets accounted for 70% of gold demand. The question of who actually owns the United States gold is debatable and made particularly opaque by complex, highly secretive gold lease arrangements. The increased calls for gold repatriation and for audits of Fort Knox and the U.S. Federal Reserve could shed light on this issue in the coming years. This is the perfect time to hold gold and silver for wealth protection. Fund redemptions, negative institutional sentiment, financial repression, and the raging currency war will ensure gold will continue its climb to 10,000 an ounce. I expect that gold will end 2013 between $1,900 and $2,000 an ounce, and silver between $40 and $45 an ounce. In a world where financial and geopolitical certainty is evaporating, no one knows what black swan event could cause the explosion in the gold price. Some have suggested it will be a failure of a major bank, or derivative exposure, or a Middle East war. A major downgrade of U.S. bonds might also be the catalyst. In 2013, as been the case since 2001, the best policy for wealth protection remains to simply buy and hold uncompromised physical bullion until we are once again on solid economic footing. Thank you.